The idea was, well, Europe can no longer import natural gas from Russia, so they're going to import it from the United States. One little problem, the US only has so much LNG export capacity. And it's not like you can go out and say, you know what, a week next Tuesday, we're going to open up a new plant and start sending gas to Europe. It doesn't work like that.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Elliot Gue of Energy and Income Advisor is a leading expert in energy with decades of experience providing actionable service and advice for investors. As a respected analyst and editor of investment newsletters, Elliott specializes in uncovering profitable opportunities in the energy sector, including oil, natural gas, uranium, and coal. Elliot, thank you for coming back on the show.
Oh, thanks for having me. It's a pleasure.
Yes, sir. Pleasure's all on this side of the table. I've been looking forward to this one. Our last interview was very popular with the viewers, and I think this one will be as well. Let's start out like we always do. And what is your macro view of the world economy and financial markets?
Well, as far as the global economy, right now, I mean, the U.S. economy looks to be holding up very well. Obviously, there's been a lot of concern about, the hot jobs number we got for December, just released last Friday, and the fact that interest rates are up, yields are up a little bit. There's even some talk now that the Fed may have to hike interest rates this year, so that's caused quite a lot of volatility in markets. I would say that longer term, generally the market actually does better when interest rates are rising because it reflects a strong U.S. economy. Outside the U.S., obviously not as good. Particularly Europe, still looking very weak in terms of their economies. I mean, I think a lot of that has to do. I tend to look through everything as of the prism of energy, but obviously Europe is suffering a great deal from, in my opinion, poor energy choices over the last really 10, 20 years. But if you look at a country like Germany, their industrial production has been falling for almost a decade now. And a lot of that has to do with their high energy costs, and they're still struggling from that. The energy crisis we saw there a few years ago isn't on the front page anymore, but they're still suffering from that. China obviously has been disappointing. I do think ultimately the Chinese government probably does even more to try to stimulate growth there, because at some point it's going to become an even bigger concern. You already have some signs of unrest there and whatnot, as a result of weak growth, high unemployment in some areas. So I think that could be an area where we'll see some upside. Generally, of course, that also is positive for energy because China and Asia are major consumers. As far as the energy markets are concerned, I'm very excited about natural gas for 2025. I think 2025 could be the year of natural gas. Right now, everybody's talking about really cold winter weather. I mean, I live in Florida, and it's been cold here, and I can only imagine farther up the East Coast and in the Midwest. And we're seeing very strong heating demand from that. We're also seeing some well freeze-offs in places like Texas and Oklahoma, which is affecting the supply side of the equation. But honestly, that's not what I'm particularly interested in for natural gas this year. Yes, February futures are up around, I think $3.95, $4 a million BTUs right now. Obviously off multi-year lows for the front month last year. But what I think is more interesting is the curve, right? So in the first half of this year, it's been all over the shop, up, down, depending on weather conditions. But when I look out in the second half of 2025, we've seen steady prices, the strip there, the calendar strip for the final 6 months of this year. I mean, it's up around 375. Not long ago, it was down in the below three. A lot of U.S. gas producers can produce profitably at 375, generate a lot of free cash flow. If I look into 2026, it's closer to four, even above four, depending upon what months you look at. And I think a lot of that has to do with two trends I'm watching very closely. One is liquefied natural gas. I think a lot of people got this wrong in 2022. You saw gas prices spike $10 a million BTUs in the US and all that, and come crashing back down to earth. The idea was, well, Europe can no longer import natural gas from Russia, so they're going to import it from the United States. One little problem, the US only has so much LNG export capacity. And it's not like you can go out and say, you know what, a week next Tuesday, we're going to open up a new plant and start sending gas to Europe. It doesn't work like that. So you have all these headlines of, the Biden administration negotiating a deal to supply Europe with more gas. It's physically impossible. The capacity wasn't there. But now, finally, this year, we're seeing growth in US LNG capacity, export capacity. These are projects that have been in the works for years. Between the fourth quarter of last year and early 2026, so roughly a 1 year period, we're looking at 4 billion cubic feet of additional export capacity. US export capacity right now is around 12 billion cubic feet. So do the math. That's a
Oh,
one
wow.
third increase there. The other thing I'm looking at very closely, and this is maybe more of a longer term theme, but AI demand, artificial intelligence demand for electricity. Some of the numbers I'm seeing are incredible. In 2020, data centers, whatever you want to call them, it consumed about 1.5% of US electricity. So about 1.5% of US electricity generation went to power these data centers. By the end of this decade, so 2029, 2030, it's going to be 9%. And so US electricity demand from these data centers is growing rapidly. Doing an internet search that is powered by AI, right? Takes 300 to 400% more electricity than a traditional, Google search that we have all done for years. So there's a lot of power demand coming from AI. It's real. We're already seeing signs of it. And, if I look out there, I like nuclear power, don't get me wrong, but you can't build one of these things very quickly. And solar and wind, of course, are intermittent. They're not ideal. You need always on 24 hours a day, 7 days a week, reliable electricity baseload sources to power AI data centers. So where's it going to come from? I think a lot of it's going to have to come from natural gas. Natural gas plants can be built relatively quickly. They also have relatively low capital costs, which is a big consideration in an era of higher interest rates. You know, doing a multi-billion-dollar project to develop a new nuclear capacity, right, is one thing if interest rates are basically near zero. It's another thing when these companies are having to pay, elevated rates to borrow money. Capital costs are a huge issue for nuclear. They're a huge issue for wind as well, right? But your natural gas fired power generation, you can put it together relatively quickly. The upfront capital costs are lower. So I think all that adds up to a really good environment for natural gas for 2025. And it may not just be, a spike. If you're trading futures, I don't know. It depends upon the weather. I'm not very good at forecasting the weather. It is cold. That will be a short-term positive. But when I look out to the second half of this year and to 2026, all this new demand for U.S. gas, I think that's a very good thing for the producers. These companies are already hedging their production at prices they could have only dreamed of 6 months ago, last summer, say. And so they're locking in considerable free cash flow. So I like a lot of the U.S. gas producers that have access to the Gulf Coast. It's where most of the LNG export capacity. Oil, I'm also bullish on, but I think maybe the more immediate upside potential is in gas plays. Oil, I think fundamentally the market's got it wrong. The reason I say that is, look at a group like the International Energy Agency, the IEA, and look at some of their oil market reports. I put one article up about this on Substack actually not long ago, but they were looking like for something like 600,000 or 700,000 barrels a day of oil production growth out of the United States alone, just the United States, in 2025. I think for Canada, they were penciling in 100,000, 110,000. So a lot of growth out of North America, which they consider those two countries to be North America. And there's some other places that are growing, like Guyana and Latin America, Brazil, right? But they're also looking for beyond those countries I just mentioned, the United States, Canada, Guyana, and Brazil. They're looking for another 700,000 barrels a day of oil production growth out of other non-OPEC countries outside those that I mentioned. So non-OPEC X those countries. This is fantasy. For one thing, U.S. oil production is actually falling or at best flat right now, and that's not going to change at with oil prices even what we've got up to the high 70s now. But with oil prices sub 85 to $90 a barrel, you're not going to see huge growth out of U.S. shale production. Now, you might see growth in barrels of oil equivalent, which includes huge volumes of natural gas produced in places like the West Texas, where gas prices are basically near zero, um, and natural gas liquids like ethane, propane, butane. That's not oil. You can't turn that into gasoline that you put in your car, at least not directly. So I think that the basic argument has been okay, well, we have all this growth in supply. We have OPEC withholding barrels from the global market. And the thought was, well, maybe that would change. And then we have demand growth, which is basically similar to or even less than supply growth from non-OPEC. But this non-OPEC supply story is falling apart. As I said, U.S. oil production is down, real oil production. It's not going to grow this year significantly, especially with prices down where they are. Guyana and Brazil, I think Guyana is a good bet that production from there is going to grow because it's a project managed by ExxonMobil, that they've been working on for years, and they're bringing it online in stages. Brazil, okay, they've disappointed a little bit lately on their growth, but it's possible. But the U.S. fantasy, and I think non-OPEC X those four countries I mentioned, is pure fantasy. I mean, these countries haven't grown oil production, real oil production, in 20 years, nearly 20 years. I just don't see it. And I think that unless there's a recession, global recession in 2025, oil demand is likely actually grow faster than non-OPEC supply. I think OPEC will continue to keep barrels off the market for as long as needed to balance the market because what do they benefit from dumping oil on the global market right now? You already have U.S. producers cutting back on drilling activity, cutting back on production. If they flood the market and prices go down, it's not going to really change that much. Yeah, you'll have a little more capital come off here in the U.S., but it's not like 2014 when U.S. producers were growing at a million and a half barrels a day every year. So yeah, I think oil looks good. The market's much tighter than a lot of these groups like IEA have been forecasting. At some point, I think that's going to dawn on markets. Speculators are not very bullish oil. Their commitments there on the non-commercial commitments on the in the futures market are near multi-year lows. I think there's considerable upside for oil. I think it's more likely that you'll see oil prices above 90 on WTI this year than say, below, 65, 60 to 65. And so high quality oil producers too, I think it could be an interesting place this year. I think that
Okay.
about covers the macro.
Yeah. Okay. Just to summarize here, so there's with the hot jobs report, there's actually a case that the Fed could raise interest rates. Energy
Yeah,
is basically a basket case of poor energy choices. Germany
right.
being the poster child of them. China, you could see some stimulus coming out of China. As far as your number one energy pick for 2025, it's got to be natural gas.
Yes.
You think it's going to have a good year there. When you look out over at the futures, those ones going out a year or so have really bounced up, which is a good sign if you're betting on it. And as far as you can see some serious demand coming out of AI. So right now, about 1.5% of our energy goes towards these data centers, and projections for 2030 is 6x that at 9%.
Right.
So that's impressive. And one thing that people haven't factored in, and I was guilty of this maybe 6 months ago, was that the LNG facilities taking this natural gas, putting it into liquid form so that you could ship it over to Asia and to Europe, that infrastructure just wasn't in place. But
Right.
we've gone from 12 billion, and a year from now we should be able to increase that to 16 billion, another 4 billion
Right.
um, cubic feet, which is really cool. So that's taken place. And natural gas, as far as like what you're talking about with the AI demand, they're a lot faster to build. They're faster with the higher cost of capital now that interest rates have gone up. It takes
Right.
a long time to build a nuclear power plant. And although
Right.
the uranium bet is still on, it's not nearly as quick as the natural gas one. If I'm not
Right.
mistaken, they could
Exactly.
turn these thing around in 18 months. They could build one. Is that about right?
Right. And, they can, and it's very flexible. You can build a small natural gas plant to kind of feed in power at peak times. I mean, it's very quick to build relative to almost any other source of power. Solar has low capital costs also, and that's why you're seeing so much solar being built in places like the United States and elsewhere. But the problem there, of course, is intermittent, and the sun still doesn't shine at night, so
Yeah.
storage is extremely expensive.
Yeah. Okay. And then as far as oil, you think that agencies like the EIA have got it fundamentally wrong, and they are forecasting that the United States is going to increase production by almost 1 million barrels a day, and that's not going to happen according to you. If anything, it's going to be flat or falling. You might see some growth out of Guyana, but as far as the U.S., you don't see any growth coming out of here.
Not significant on the pure oil side. Now, if you're looking at barrels of oil equivalent, which I think a lot of people conflate those two, one thing I notice, if you look at like IEA, for example, they talk about U.S. oil production north of 20 million barrels a day. Well, the U.S. really produces more like 13.5 million barrels a day of oil. That other 7 million is really natural gas liquids, um, and that are being kind of pushed into the oil stream. And a lot of that, in my view, is illegitimate. I mean, 65% roughly is ethane and propane, which are the two lightest natural gas liquids are basically just hydrocarbons. You have methane being CH4, so it's on the light end, and as you start adding carbon and hydrogen molecule atoms to the chain, you get ethane, propane, butane, isobutane, etc. Those lighter NGLs, ethane and propane. Ethane, a lot of it in the United States anyway, is burned alongside natural gas. So it's not really oil. So I think a lot of people are looking for this growth in US oil production, but actual oil production is more likely, in my view, to fall. And you can see it in the individual producers as well. Look at a name like a Devon or a Diamondback, symbol FANG. Um, if you look at their production, right, it's gassier and natural gas liquider, right, relative to oil over the past few years. For example, not long ago, Devon, I think, had about 50% of their production was actual oil, and the rest was gas and natural gas liquids. And then now I think it's about 46% as of the last quarter, somewhere around there, 46.5%. That's a big drop in percentage terms. So, you see, if you look at their oil growth rate, right, they're growing their oil production, some of that via acquisitions, but they're growing their gas production at multiples of that rate. So these big production numbers you see from individual producers, they say, we're going to grow output 10% next year. That's actually not oil. That's most of that is gas or gas liquids. As they move into new areas of key shale fields like the Permian, I think it's more likely to get gassier than oilier. And that's a big problem because obviously gas prices being so low in West Texas, particularly, you do have a new pipeline there, the Matterhorn pipeline, that's bringing that gas to a different hub in Texas. But still, gas prices are low relative to, say, Henry Hub over in Louisiana. So yeah, there's a fundamental disconnect between the debate, what is oil, right? And in my view, oil is certainly not natural gas, and it's certainly not like ethane. Might be natural gasoline or some of those heavier natural gas liquids, but that's a tiny portion of the overall natural gas liquids barrel.
Okay. We recently had Christine Guerrero on the show, and she did a 2 hour presentation on the Permian Basin, and
Mm-hmm.
her base case was basically that we're She's kind of, I think, in the same camp as you, is that we're kind of topping out here and,
Mhm.
flattening out. And a lot of it is there's just not as much left there anymore unless the price goes up to where they
Right.
can, be incentivized to get some of this cheaper stuff. But are you in that same boat?
Yeah, absolutely. I think that, there you have the sort of tier one acreage or the premium acreage in the Permian. And a lot of the better producers, names like Diamondback, for example, they do have some runway of that premium acreage. But remember, shale, I like to think of it as it's more of a manufacturing business than traditional oil and gas production. Um, how much oil you produce in a given quarter is a function of how much capital you want to spend, right? So how many wells you want to drill, how many wells you want to complete. And so a lot of these bigger producers are, I mean, they're not anxious to run through their inventory of prime locations at 70, $75 a barrel. They might be ecstatic to do so at $100 a barrel, but they're not really that, it's not that compelling at current prices. And so they're more likely to cut back on their capex, preserve free cash flow, and then look to spend a little bit more when prices improve. And then, yeah, longer term, I think the risk is as we move through this inventory of prime acreage, they're going to start going to their tier two or tier three sites. And different producers have different amounts of tier one, tier two, and tier three acreage, but without a major increase in productivity, and it's more incremental nowadays than it was, say, 10 years ago, that's going to mean higher gas cuts or lower oil cuts, um, less oil. So every BOE, barrel of oil equivalent you produce, might be 40 or 45% oil rather than say 55 or 60%, which we saw not long ago. So yeah, and you're seeing some producers grapple with that in different ways. I mean, Devon announced, for example, an acquisition in the Bakken, North Dakota, which is much oilier than the Delaware Basin of the Permian, where their main operation is. In terms of the oil cuts are higher. So, but I do think it's an issue. I think it's an issue that it's already apparent in the data, but it'll become more apparent as time goes on. And we see again more and more of these disappointing gas or oil side growth numbers, and just a very gassy wells in some of these areas.
Yeah. Okay. Okay. Um, Got some listener questions here.
Yeah.
Pat wants to know about drill, baby, drill. What are your thoughts on this? Is it possible to reduce energy prices by 50 to 70% and still make a profit?
No, it's not. As I said, I mean, here's the thing. I think that, okay, first of all, drill baby drill is basically a campaign slogan, a political campaign slogan. But there is a real element to it. Governments historically really can't do much to encourage more energy production, but they sure can do a lot to discourage energy production. If you tie up the industry with red tape, new rules and regulations, if you're openly hostile towards the industry, you're not going to encourage more drilling activity. You're going to encourage companies to preserve capital, to pay out more capital to their shareholders rather than spend money in an environment where they feel like they may be attacked or may not be able to get new well permits, things of that nature. Um, and certainly, I would say that was the case under the Biden administration. We had some policies like the LNG export um, permitting pause that came in place a little over a year ago now, I guess. It didn't actually have any impact on near-term permitting, but it impacted companies that had not got their permits yet on new LNG export plants, which is sort of a 2029, 2030 area. So the near-term impact was nil, but psychologically, it is a concern, and companies make this business decisions based on partly on the current environment, but also partly on the outlook for future policy and the future environment. And if there's a lot of uncertainty about that, then they're going to spend less on a balance. However, the United States does not, it's not a socialist country. It's not a communist country. You don't have a national oil company, right? A lot of countries do, right? But the government can't say, we need you to produce another million barrels a day. This is not how it works. If you look at a company, again, I'll go back to a name like Diamondback. Acreage and I'm using it as an example, not because it's even a stock I currently recommend. I don't. But it's a high quality producer. Their acreage is in the core of the Permian Basin, which is the best play in the best shale play in the United States. I calculate their break even rate at something like $26 per barrel of oil equivalent. Okay,
Wow.
so very low. And that barrel of oil equivalent includes about a little over 50% oil, and the rest is gas and gas liquids. So they generate tons of free cash flow, even at current low oil and certainly low gas and natural gas liquids prices. However, about $13 a barrel of oil equivalent of that is their capital spending. And their capital spending, what is it? Almost all of it. There's some pipeline build outs and things of that nature, but almost all of it is drilling new wells and completing those wells. And that is the lever with which they govern how much they're going to produce. If if Diamondback wants to produce more oil, they can do so, and they can do so quickly. They just spent a little bit more capital for a couple of quarters, and you're going to see an uptick in oil production. Let's call it 6 to 9 month lag. Um, More likely, you would see them raise their capex guidance a little bit, and then maybe boost it again at the middle of the year if they wanted to do that. But that will also increase their costs, right? So if they increase their capex, it's going to increase their cost per barrel of oil equivalent, their break-even cost. Now, that's worthwhile if prices are high enough that the additional incremental revenue you earn from producing more barrels offsets the incremental boost in cost, right? So at, 90 or $95 a barrel, they may well make that move. They may well make that play, but they're not going to do it at 70 or $75 a barrel. And they're sure not going to do it at 60 or $55 a barrel. So the idea that drill baby drill means companies are going to go out and spend a bunch more money, produce a bunch more oil or natural gas, to me, it's naive, very misleading. What the Trump administration can do is take away some of the shackles or uncertainty surrounding the industry. And in my view, that's a good thing longer term, because it means that, these companies can respond to things like wanting to export more liquefied natural gas, wanting to get well permits quickly and efficiently, not having to worry about, potentially crushing regulations or regulations that raise their costs. So on balance, that means that their break-even costs go down a little bit. But I'm not talking about, $10 a barrel. It's more of an incremental boost. So I think drill baby drill means that at any given price level, you could see more supply from US companies. But the idea that that's going to have any kind of a near, intermediate, or even long-term impact on US production levels, it's not. The only way I could see that happening is if the government literally handed them money, which they're not going to do. So, and I don't think we want them to, honestly. I guess I'm an old-fashioned, free markets guy, but to me, the whole idea of price, right, is to act as a language between buyers and sellers, between users and suppliers. The price goes up, it tells suppliers, hey, the market could use more oil or gas or whatever it is, pencils. If the price goes down, the opposite. If the price goes up, it tells people consuming oil, maybe you should try to see if you can use less, right? So that your costs will go down. And vice versa when prices go down. That price signal ultimately governs everything. You can fight it. Some countries can fight it for years, but ultimately it will win. And so ultimately the price of oil needs to go up if you want to see more U.S. oil production.
Okay.
It's that simple. It's not a political decision. There's nothing Donald Trump can do to force them to do it. I don't think he would probably want to. I mean, lest we forget, he is a businessman. He in the first term, he did have discussions with the oil companies about what they needed and things of that nature. I don't think that's suddenly going to go out the window this time.
Okay. All right. So basically, drill baby drill, although it's an amazing campaign
Right.
slogan, the reality is governments can't really encourage these oil companies to drill more. All they could do is remove red tape that's kind of
Right.
restricting them from doing so.
Right. And certainly that's a huge issue in the United States and, in Canada too, right? But it's not it's not like you're flipping a switch. It's more of a tailwind for the industry or removal of a headwind maybe is a better way to put it.
Okay. Okay. All right. We got a comedian in the crowd. Loza wants to know the best way to play Canada Energy in light of the Trudster pursuing his new job offer with the World Economic Forum.
Yeah, I like that. I'd never heard the Trudster before. Yeah, we do have some Canadian stocks in our model portfolio. One name that we don't actually currently have in the portfolio, but we have liked is Canadian Natural Resources. It's a name that has oily production, which I think is going to be beneficial over the intermediate term. I think the world needs more oil. The other way, we've liked to play Canadian energy is via the infrastructure plays. Like we have Pembina in Pembina pipelines in the portfolio. Obviously a nice yield there. A lot of capacity in Western Canada, going to serve the liquefied natural gas export terminals there, just as in the United States, right? The world needs more liquefied natural gas supply. Um, it is it is the easiest way to increase your electricity production. It's relatively environmentally friendly compared to, say, coal, right? Which is, for a lot of these countries, that's the alternative, right? And so I do think that, eventually all the gas there's plenty of markets for all the gas coming from the United States and Canada. Let's face it, if you're Europe, would you rather buy your liquefied natural gas from somewhere in the Middle East or Africa or from, Texas or Canada? It's obvious. So, I do think, Pembina benefits from that. That's a good sort of low volatility way to play it, especially right now where we do have some, politics related volatility going on in Canadian energy stocks. Pembina, I think, is a name that has pulled back quite a bit. So I think this is a good opportunity to get into a name like that. For a long time, Pembina was above our buy target. Recently, it's got back down to that level. Yeah, I think that's an interesting way to play Canadian energy.
Okay. Let's go into that. So Pembina, they're basically services, right? So I haven't heard of these guys. So do they have these LNG facilities that is basically taking the natural gas, putting it into liquid form so you can ship it out, or?
Most of the business that they have is pipelines and facilities for storing gas, some processing, but mainly it's pipelines, transmission. So they're what we call a midstream provider. So you have upstream, the guys that produce stuff. Downstream is basically refining and selling. And then the midstream is transportation and storage, and they fit right there. There are some there is a new LNG terminal going on stream in 2025 in Western Canada as well. And I believe it's already started or soon, very soon will. And there's also a floating LNG export terminal. So floating LNG, one of the big problems with LNG export, I mean, it's a pretty big footprint. You're building this big onshore facility that's connected by pipelines, right, to the gas producers and processing facilities. And then it's a big deal. It's a big facility. And so, as I said, you can't build this capacity overnight. You can't just slap it up there. These LNG platforms are usually like old tankers that have been converted. They're much smaller. Their capacity is much lower. The benefit is it's a boat, so you can move it around.
Yeah, it's
So
mobile.
you can, yeah, and you can slap up export capacity or import capacity relatively quickly. But there is one that I believe is going to start construction in Q1, I think, this year. I don't remember exactly what the timetable is, but so that'll be a story probably 2026. more export capacity coming out of Western Canada, liquefied natural gas capacity. So yeah, I think it's a valid way to play that story. And I always think of the midstream as kind of like the chicken's way to play energy because you get this really nice yield. I think Pembina, it's up around 10%,
Okay.
somewhere in that zone. And you benefit from the increases in volumes, but you don't have the direct price risk that you would in a producer name. And so boring or less volatile can be beautiful. Certainly was last year. A lot of our favorite midstream names, Pembina did very well, but also on the U.S. side, names like Enterprise Products Partners, EPD. They own pipelines. They also own processing facilities, and they own some export facilities on the Gulf Coast, or have stakes in export facilities on the Gulf Coast. That did very well. Also has a very nice yield. Energy Transfer, another name we like, ET symbol there, also in the midstream area. They actually performed better than the upstream names last year because they're less sensitive to price. They're more sensitive to volume. So this volume of gas demand that's coming, this volume of export demand, they benefit from that. They're building those pipelines to move that gas to market. Or you look at a pipeline like the Matterhorn pipeline, which connects the Waha hub in West Texas with the Katy hub, which is farther east in Texas. It's a gas pipeline. It's designed to bring that gas out of the Permian, basically, the Western Texas, and move it to a hub where it's more attractively priced. They're going to benefit even if gas prices are very low because those producers pay a fee, right, to use that pipeline. So things of that nature. It can be a very easy way, or not easy, but a less volatile way of playing some of the trends I'm talking about is to look at that midstream. And, in Canada, as I said right now, there is some political volatility there. I think a lot of it ultimately is rhetoric and political positioning, but I do think that there's some volatility there. Obviously, some volatility in commodity pricing. When hasn't that been the case? And so that's a good environment to own some of these midstream names as well. Another producer I'll mention, and this is not a Canadian company, but they do have a lot of assets in Canada. The symbol is OVV. The name is Ovintiv. I believe that's how you pronounce it, all in caps for some reason. But this company owns a considerable gas production in Western Canada. The Montney Shale, for example, being an area that they operate. And that area I do think will benefit from that export as well. Not a Canadian company. It used to be actually, but not a Canadian company anymore. I think they're headquartered in Colorado now. But yeah, they do benefit from that story as well. And I think that's a good one. I think that's going to benefit that Western Canada gas hub quite a bit.
Okay, so some of these midstreams, Pembina, Energy Transfer, Ovintiv. You mentioned Canadian Natural Resources. That kind of goes into Scott's question here. They've got heavy sour crude up in Canada, right? And I was
Yes.
talking to Rick Rule about this, and he mentioned that if we've got a lot of capacity to refine that down in the Gulf, and if we can open up that Keystone pipeline, or I
Yes.
should say, if Trump can convince him to do it, then could that be pretty profitable for that company?
Oh yeah, absolutely.
Okay.
I think one of the things that people don't fully recognize is that a lot of US has huge refining capacity, right? And a lot of our refineries here in the United States on the Gulf Coast particularly are very complex refineries, meaning that they're able to refine heavy crude, sour crude, um, a lot of crudes that some places, say for example in Asia, they're what we call basically basic distillation capacity. They're not capable of refining some of these more complex or heavier, sour grades of crude. Heavy crude basically just means it's harder to refine into things like gasoline. Sour refers to the sulfur content, just as an aside. Um, but the US built up this complex refining capacity over decades because US oil supply was getting heavier and sourer, right? However you want to say that. More sour. How's that? So they kind of built up with that in mind. And they spent like billions of dollars in capital on upgrading these refineries. And then shale comes along and it's all light sweet crude. But the problem with that is that those refineries really aren't set up to refine all light sweet crude. And so they work better if there's some mix of heavier and sourer grades of crude. So that heavy Canadian crude, a lot of people think, well, is that going to trade at a huge discount? Well, it is actually in high demand because mixing that, blending that with lighter US shale crude, some of it is super light. It's, again, barely crude oil, right? It's got so much natural gas liquid content, shorter hydrocarbon molecules. It's really tough for these refineries to refine. And, some of our traditional sources of heavy oil, Venezuela, for example, not exactly not exactly a viable option at the moment, and probably won't be for some time. So yeah, that Canadian heavy sour crude is, I think that's an opportunity, no
Aren't,
doubt.
aren't they producing something like 1.5 million barrels a
Yes,
day, something like that?
yes they are. And one of the things again there is because a good portion of their production is oil sands, right? Um, Unlike the U.S. shale, you're not getting a ton of gas and gas liquids mixed in there. It's oil. So that to me, though they're obviously their capital costs are higher, their fixed costs are higher for an oil sands business relative to say traditional oil production or shale even. It is oil, and I think the prices are going to be high enough to make that very attractive. A name like that gets hit when oil prices are weak, which they were, of course, towards the end of last year. But as I said, I don't. One reason I don't think that low oil prices, say sub 70 for any length of time, are sustainable is you're going to see production fall. You're going to see companies that are on the higher edge of that cost curve cut capital spending or cut production. I think that prices over the long haul are going to be plenty high enough for a company like CNQ to make good, make a nice free cash flow yield on their output. And one of the problems I have with some producers here in the U.S., like a Devon, honestly, is that a lot of their production is really light stuff, gas and natural gas liquids. Yes, the stock is really cheap, and we can talk about that more in a minute. But yeah, I mean, a lot of their production growth has been on the gas and natural gas liquid side, and I mean that's a problem. It's not misleading. I mean, they're not trying to trick anyone. It's you can read the 10Q and figure out what they're producing. But the idea that this is all oil, which I think sometimes is sort of in the layperson's mentality or in the media's mentality, it's not actually oil.
Yeah. Okay. Um, okay. Real quick on Canadian Natural Resources. So, if we open up the Keystone Pipeline, do they increase their production from 1.5 to something north of that? Is that kind of a bottleneck for them?
um,
Like, where are they getting it refined right now? That if we open up the Keystone, it's going to be really good for them.
well, I think the biggest thing would be the price differentials. So oil in that region trades at and this is true with oil in different places, also gas in different places. It not only depends upon what you're producing, it depends on where you're producing it. So oil in that part of Canada, right, is going to trade at a price, is been trading at a price discount to say oil delivered to the Gulf Coast. Um, Oil in West Texas, for example, often trades at a discount to oil in Houston. So it doesn't even have to be that far. So by opening up more capacity to move oil out of Canada south into the United States, you can arbitrage away that price discount. So
Ah,
some barrels that might be sold locally at deeply discounted prices can now be sold in Houston or somewhere in the Gulf Coast at a higher price point. That's the biggest immediate advantage. And the same is true with gas, right? So, for example, in natural gas, the largest gas field in the United States is the Marcellus Shale, Appalachia, big shale producing field. But gas prices are very low there because there's no local demand. It's not a very heavily populated area. Um, New York doesn't allow pipelines, don't get me started, to transverse from the neighboring state like Pennsylvania into New York where it could be badly used. So gas tends to get trapped there. So to produce profitably, you need pipelines to move that gas to Louisiana, to Texas. Otherwise, the price is too low, even for a very low cost producer. So the better producers there have tons of capacity to move gas out of the region, takeaway capacity, we call it. The same is true with Canadian natural resources. If you have more capacity to move oil to some place where prices are higher, your realizations go up. Even if WTI stays exactly where it is, your realizations go up because you're selling more oil into the WTI market.
Okay. Okay.
And
That makes
like
sense.
gas too, right? So here in the US, 395 I think today, February futures, right? In Europe, right? It's more like 20. Right.
Yeah.
So the problem, so they would love to have that $3.95 gas, but they can't have it because there's not enough capacity. So a lot of these things are it's about capacity. And, it's one of the reasons I like midstream many times. It's about capacity as much as capacity to move it, as much as it is to increase production of raw barrels out of the ground.
Okay. Okay. Yeah, I was looking up their all-in sustaining costs on a barrel, and it was like 13 to $20 Canadian or something. I'm like, how
Right.
is this possible? But that you
Right.
just explained it. Okay.
Right. Right.
Okay. All right. He is also asking about, okay, so Devon, so you kind of touched on them.
Yeah.
They do more of natural gas and its equivalents than they do of oil.
Mm-hmm.
Macro thoughts on Devon. We are going to break this into two parts. When we come back, we will talk about Devon Energy. We will talk about coal, AMR, Peabody, Warrior Met Coal, and we will dive into uranium. So if you're new to the show, be sure to hit the like, the subscribe with the little bell notification icon, and then you'll be notified when part 2 comes out with Elliot Gue. Thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.